income statement, we used a depreciation of the 25,000 plus 11,000.
That's exactly right.
We use both of them. That's what I was asking. So we use the 25 and the 11 on that side.
Yep,
Right.
we did.
Oh, okay, that's. I just didn't see it, so I wasn't sure where we added it in, and that's what I wanted to make sure.
Yeah, I went through this this afternoon and triple checked all the calculations.
Okay. I just because I kept reading over that, going, where is this at? Where are we actually adding this in? That's what I wanted to know. So I was mistaken where we had to put it in. So sorry, Ms. Lauder, I didn't mean to sidetrack us on anything.
No, that's exactly what we're here for. A chance to check in. Just kind of feel like you're not out there alone trying to make sense of all this stuff.
Well,
I did. Go ahead, Andrew. I'm sorry.
I was just saying, I really appreciate that because some of this stuff, I mean, I'm new to a lot of it. I mean, I've taken classes, some of it in there, but I'm new to a lot of it. So.
Well, accounting's just not something you can just pick up a book and quickly learn. I think sometimes those theories of marketing and theories of management classes, a little easier to grab a book and read some good theory, have some discussion on it, and kind of master the topic.
Right.
Accounting's really not that way. You got to practice it a little. Got to have somebody maybe break it down and explain it a couple of times. It's got a different sense to it.
2 weeks in, I have a true appreciation for CPAs.
Well, that's my whole objective, is to make you realize CPAs are more exciting and more helpful than Hollywood likes to make them.
Yes, they most definitely are.
Okay. I thought we'd take a look at your 3 chapters that you had to do in Chapter 2. Or Unit 2, sorry. Chapters 3, 4, and 5 in the Little Black Book. That's our last chunk out of this book. So this is the last week you're going to have the Little Black Book. Then we'll move into the more hardcover traditional textbook. In the Black Book, Chapter 3 is all about the last financial statement that you're going to learn. The statement of cash flows. You've learned a balance sheet. You've learned an income statement. We had homework things that made you practice doing them and learning about them. But we saved this statement to this chapter. The statement of cash flows, the purpose behind it is actually pretty simple. It tries to explain where the money came from and where it went to. We all do it in our personal life. You get online, go to the ATM, whatever, see your bank balance, and all of a sudden you're going, how is that the balance? Mentally you're going through, I know I got paid. Oh yeah, but then I spent this, and then I did this, and okay, now the balance kind of makes sense. That's what the statement of cash flows is trying to do for the reader. Explain where the cash in the company came from, where it went to, and how the balance is the balance. If you take a look with me at the Little Black Book, page 64 and 65, the opening pages of this chapter, you'll see again a sample of the statement of cash flows, just like the samples you had for the other financial statements. And the numbers, the lines are numbered so they can refer to them. So the very last couple of lines of the statement of cash flows, line 47 says net increase in cash in 2011. All the lines above that were trying to explain where the money came from, where it went to. And when they netted out the money they got minus the money they spent, it came to $26,000 increase in cash from the beginning of the year to the end of the year. Lines 48 and 49 just kind of reiterate that same thing. 48 says, we began 2011. They write it as we ended 2010 with $107,000. And they ended 2011 with $133,000. An increase of $26,000. So what that's trying to say is that the statement has accounted for the complete change in cash from beginning to end of the year. the statement is broken up into 3 sections: operating, investing, and financing. This is no different than you trying to take all those things you've done with your checking account and break them into categories based on what they're related to, such as your job. That's going to provide your income. That's going to cause some of your expenditures of money. Maybe housing, going to be a whole nother category. Family, another category. Education. So you could make your own categories. And corporations have kind of narrowed it down to 3 categories. Operating, which is the day-to-day operations. Investing has a different connotation. It can be a literal investment in stocks, bonds, etc., or buying and selling plant assets, such as new equipment, new buildings, either buying new ones or selling the old ones. They would all be considered activities that involved your cash. Just as buying new stocks or bonds in other companies, or selling the ones we have and liquidating them and getting some cash. So you'd either have an inflow of cash from these things or an outflow, or a little of both. Financing is any dealings with creditors or owners, which in our case would be stockholders. Because they're all the ways that we finance our business. We either borrow the money or the owners contribute it. So when we get money from the owners or we get money from borrowing, that's an inflow. When we pay back our creditors or we give dividends to our owners, those are outflows that are in the financing category. So one of the things this chapter is going to want you to do is to be able to read a transaction and decide which of these 3 categories it'll go into. The other thing will be an understanding that there are actually 2 types of there's 2 ways to prepare them: the direct method and the indirect method. Direct is the one that I don't even think they show you a picture of. It's the most helpful, but the hardest in practice to actually create. Let's see. It's the most informative, but hard to create. This one would tell you all the outflows and inflows, and this is the one easiest to create. So the book goes over the indirect method is by far the more common one. If you were to go grab the financial statements for most companies, almost all of them do the indirect method. So thus the one they spend their time teaching you. How are they different? Only difference is in the operating section. Again, if you're on pages 64 and 65, I think there are 2 page numbers, you can see the statement of cash flows just talks about sources and uses of funds. But if you flip the pages all the way over to page 72, it shows a statement of cash flows using the indirect method. And you'll see that there's 3 categories. The top one are the operating transactions or events that happened that caused the amount of money the company either received or spent in the operations of its day-to-day business. And according to this statement, by the time they took all the goods and bads, money coming in, money going out, the operations day-to-day brought in $23,000. The two things that they did in the investing category where they purchased some more capital expenditures, nice fancy business word for we bought some stuff, bought some plant assets like buildings and new equipment, and they cost us $34,000. But we did sell some of our old investments. That brought in $3,000. So when those are netted together, that category actually spent more money than it brought in. Then the last category is the financing, and we increased our bank debt, so we took out a loan, but we decreased some other long-term debt. So we must have used that loan to pay off $50,000 of other debt, and we gave out dividends to our stockholders. So all told, the financing area brought in $34,000. But if we add all three categories together, that's how they get their $26,000 increase in the checking account this year. That kind of makes sense.
So you're saying the investments are considered a negative if they got the parentheses around it, right?
I can barely hear you, Andrew. If there's any way you can turn things up, or
Can you hear me better now?
yes, thank you.
The investment, that's looked at as a negative, right? You're saying that with the parentheses around it, that's negative?
That's negative only because the things we did in that category, we did more spending than we did bringing money in.
Oh, okay, because the sales of the investment would be the money bringing in.
Right.
Okay, going on. I got you.
Now, the next example you look at could be the other way around. That company may do more selling of their old investments, liquidating investments, and bringing in money, and not do so much purchasing. And they could actually have a positive cash flow from investing. So there's no set pattern to whether they're positive or negative. It all has to do with how much of each one you did.
Okay.
The chapter is going to walk you through what goes in each category. But what I want to try to explain is the indirect method. If you look at the operating section, instead of saying things like the investing, like the financing and investing area do, they're very clear cut. Sold something, bought something, and how much money. Then you get up in the operating section, and it doesn't describe those things as neatly. It just says net income, then depreciation, then an increase in this account or a decrease in that account. What they're trying to do, the indirect method assumes net income is pretty close to cash coming in. Now, we know that's not perfectly true. Net income's great. It's the result of our revenues and our expenditures, or expenses, but revenue can happen and we could not get paid for it. You can see an income statement that shows great amounts of revenue, but the company could still be waiting to receive the money from the customer. Revenue just means we have done the work or sold the product to that client. The client may have 30 days to pay us. It may be even taking longer than that. So we could show a great income statement and a terrible checking account. And that's where a lot of problems with companies happen, is they're finding customers, they're getting sales, but they're not bringing in enough cash to replenish the shelves and to pay their employees and things, and the timing's just off. And they need a lot of cash those first few years to keep them being able to restock while they're still waiting to get paid. Kind of get them over that time lag. So they start out with net income and then say, well, there's a few things in net income that aren't truly reflective of cash, such as net income is the number it is because revenue had to have all these expenses taken away from it, like depreciation. If depreciation hadn't been taken away, net income would have been bigger. Well, depreciation doesn't use any cash. So we can add it back to the net income and say, what would net income have been if we had never subtracted out depreciation? So that's why you see depreciation being written right below net income as a positive addition to the net income. They're trying to add it back or almost go back in time to say, well, what would the net income have been if we hadn't taken away depreciation? So they add back depreciation, and then they look at other things. If they have an increase in inventory, which this one has a significant increase in inventory, it means the company spent a lot of money on top of buying things that they did end up selling or expensing. They also bought a bunch that they stocked their shelves with. And that would have cost money also. The increase in accounts receivable means that there are customers who are showing up as revenue because we sold them a product or did a service for them, but we haven't collected their money. So net income may be a little too high when you try to compare that to cash. You have to kind of adjust net income down to go, that doesn't reflect the $40,000 I'm still waiting to get. So they're knocking net income down a little by the amount that they're waiting to still get from customers.
Ms. Larner?
Say that again.
Is there a way, maybe I'm not understanding it completely, why you can add depreciation back into it, though?
All we're trying to do is reconcile net income to cash. And instead of just straight up looking at the cash and saying what came in, what went out, they say, well, revenue's pretty much cash coming in. Expenses are pretty much cash going out. And when you subtract the two, you should have the net effect of cash. Then you got to stop and go, oh, there's a few problems with that. Net income, the revenue coming in might have included some money we haven't received yet. That's why later they subtract out $40,000 from that.
Right.
Take into account those people who haven't paid them yet. But then also, net income is affected by expenses. Some of those expenses didn't involve cash.
Okay, so that's
so
why
we're adding it back and saying, well, without that, we actually would have been, $212,000 in net income.
Okay, I see. Because it's not actually cash that you lost there. It's a depreciation. It's really not a cash value. I see it.
Right. That was money you spent way back when you bought the machine. You're just kind of slowly allocating the use of it over time. So depreciation isn't really reflective of any money flowing out of your hands this year.
I see. Okay, I understand it now.
So they adjust the current assets and liabilities. That's what you're seeing with the increase in accounts receivable or the increase in accounts payable and so on. So the indirect method starts with net income, does some adjusting, and finally comes to a total for the operating category. The direct method would have just said cash received from customers, cash spent for this, cash spent for that. Oh, it nets out to this number. Both methods would have come to operating category $23,000. It's just how they go about it and how they display the information. Even though this seems like a convoluted way to do it, it's a much easier in practice way to do the statement. It takes a lot more time to try to break down all the cash transactions. So out of all that, you're probably going to see a little practicing looking at a statement of cash flows. But then after that, you're more going to need to interpret them. If someone created a statement of cash flows for you, do you understand what it means? That's the managerial aspect of this class, is being able to take these statements that hopefully are going to be brought to you by the accountant, and you as the manager are going to be having to understand all the decision making you've got to do and what happens with those decisions. How do they end up affecting all the financial statements? What are you doing? And the decision you make makes the financial statement look a certain way. What is the stockholder going to think of that financial statement looking that way? What's the bank going to think about it? So you've got all those different users to think about the effects of your decision. So all that said, to try to say, work on the statement of cash flows, but I'm not as more concerned about you making it as understanding what's involved with it and why it exists. What does it tell you? Chapter 4, lost my chapter number there, is all about the generally accepted accounting principles. We've been using them as we've been going through the material. I just haven't referred to them by their proper name. These will not be hard to read through the chapter and comprehend. The generally accepted accounting principles, I think I probably mentioned this in last week's lecture. The stock market crash in the 1920s, a lot of it had to do with companies trying to get investors to join in their business. But everybody was preparing financial statements differently, and nobody was making sure that those financial statements were accurate. And so they were putting their best face on their business, trying to make a brochure. It's almost like an online dating site. Everybody tries to put on their best face and only put out good aspects about themselves, maybe not even truthful aspects about themselves, to get others interested. That can be dangerous in online dating, but it was also dangerous in dealing with finding investors, because investors bought into the businesses and then later found out they weren't quite what they thought they were going to be. So accountants got together and said, you know, we need some generally accepted, everybody's going to follow these rules. And out of that came generally accepted accounting principles. We call them GAAP. Accountants, when they come along and do audits of the books of a business, they are making sure the books are being kept the way the rules say they're supposed to be kept. So they make a statement in the financial statements that says, we have examined these financial statements and they are in accordance with GAAP. It doesn't mean this company's doing well or not doing well. It just means every number on these financial statements has been checked and they're truthful. So if you grab the balance sheet of a company and it says they have this much in cash, they really have that much in cash. If it says they have these liabilities, those are the liabilities they have. There aren't more that they just didn't tell you about. The auditor checked, those are all the liabilities. It's up to you as the investor or the manager to decide if you like what you're seeing. All they're doing is telling you that you can trust what you're seeing is really the numbers. Some of the things that they decided in the generally accepted accounting principles are how things were going to be reported. So they're going to take a paragraph throughout pages 76, 77, talking about the rules that they follow in preparing financial statements. You won't have to be tested. You won't be asked an essay question to define each one of them. But they just you need to understand those are the underlying things that happen in financial statements. For example, on page 78, consistency. You just saw that there are several ways to keep track of depreciation. Straight line, double declining balance, all these other methods. Consistency says that a company cannot change their mind every year and keep messing around with which way they do it, because just changing your depreciation method might have a significant impact on your net income. So there's an art of manipulation that can happen. A company can decide to do straight line one year and change their depreciation method so that all of a sudden their net income looks better, and kind of fool investors into thinking, our company's doing a lot better. Consistency rule says you've got to stay with what method you chose in the first place. You can't go changing your mind all the time. And if you do, for some reason, have a real good reason to change methods, then you have to explain it in the financial statements and the notes that come with the financial statements, saying that the $20,000 increase in net income this year is due to a change in depreciation methods. In other words, it isn't because I was such a great manager, it's because I changed depreciation methods. So those kind of go along together. Consistency, full disclosure means disclose everything. keep nothing hidden. Those things will come into play as we're talking about other aspects, even in the other textbook, that we will always be keeping in mind that we have to stay consistent, that we have to fully disclose information. And another good part of this book is chapter 5, and that tells you how to read an annual report. When a company publishes their financial statements, they will do so generally in an annual report. More and more they're online, but if you can get your hands on a paper one, you would see it in more the form I'm talking about. It came out looking like a small catalog or magazine. Lots of glossy pages showing the latest model of the product or all the wonderful things happening in the company. And then the back half of it was the nitty-gritty financial statements, auditor's letter, notes to the financial statements. Oftentimes now you can see these things on their websites. Some are interactive, where you can click a button and it displays the financial statements and the annual report, and you can click through it. Some have turned those glossy pages into little videos. Just another way to tell you how wonderful the company's doing. Those glossy pages in that front half of the annual report aren't audited by the auditors. Those are pretty much the commercial that comes along with the financial statements that are actually audited by the accountants. As you're preparing to write your paper and think about business problems that you might be dealing with, or thinking about starting a business and doing a hypothetical business start, it might be nice to look at the financial statements of competitive companies that you would be up against, or to think about how the financial statements would be affected by this business decision you're thinking about or writing about. Let's see. That's really all our 3 chapters. By far, chapter 3 is the meat of what you're learning this week. 4 just kind of explains some of the theories behind, and 5 is a great resource. I know it's been kind of short, but feeling okay with this stuff?
Yeah.
Okay.
Yeah, I'm feeling pretty good with it.
Good. Well, I will save the video, save the Excel file, email out the link in the file like I did before, and please let me know if you're having any trouble. Corey, I don't want you hanging out there alone, okay?
Okay.
So please keep me posted if you're not hearing from your group members, and
Yeah, I'll let you know.
we'll figure something out.
Okay, sounds good.
Okay.
Join us if he wants to.
That would be great. Why don't you guys continue to talk about that?
Okay. Yeah. I mean, being as how we're doing as a group, I think it's actually going to work really good. And Jason, you can attest to that. Doesn't it seem like it's going to work good?
Yeah, we're gonna have a lot of input. So essentially, we're gonna have 4 small groups coming together and comparing each other's answers. So we'll have some good collaboration. And Corey, you just get back with us if you don't get any responses. You just get with Andrew and I, and we'll get you into our group.
Yeah, I'll definitely let you know if I don't hear back from him here.
That sounds good. That sounds
Okay,
good.
guys, make sure that you're learning from each other and that your groups are all participating. I don't want anybody riding the coattails of some hard-working student out there.
Right. No, everybody in our 2 groups seems like they're on board and want to help. So
That's great. I wish you guys could come over to my associate's degree class. Oh, I'm spending more of my time dealing with my group member won't participate. I haven't heard from them. It's been fun.
Twice now, Jason, and our groups have met twice, and it's been almost I would say 90% participation in the 2 times we met. So
That's
we're gonna
great. Okay, well, let me know how I can help.
Absolutely. Before we go, I do have one question if you have time.
Oh, no problem.
I'm struggling on the double declining balance depreciation.
Okay.
And I have an Excel spreadsheet, and on our question number 6, on double declining, I'm confused. Do I use a 40% rate?
No, you're going to use a 20% rate. It's a 10-year life.
Yep,
So
I got
double
that.
it would be 20%.
Sorry, thank you. That makes sense. So if I use a 20% rate, and then would I use the 250,000 as my baseline or the 220,000?
Double declining does not use salvage value. So you're going to go right with the 250,000 times 20% will give you the first year's depreciation.
Which would be, yeah, which would
50,000.
be the 50,000, which would give me the 200,000 as the end of that year's value, correct?
Exactly. And that 200,000 then is multiplied by 20%
Yeah.
for the second year.
Which is 40,000, which gives me 160,000, 160,000 times 20%, so on and so forth.
Exactly.
Now, should that balance out at the end?
That last year, you may have to fudge the numbers a little. It's almost like making your last car payment.
Yeah.
You don't necessarily pay the exact number you've been paying through all those other car payments. You pay whatever it takes to finalize it. You want to make sure that you finally drop to a book value of 30,000 and no farther. So your depreciation should whittle you down from 250 to 30,000.
To 30,000. Oh, okay. Okay. I see. Yep. And I'm at 26,844. So I need to fudge that last.
Yep.
Makes sense. Okay. I like straight line depreciation.
I do too. A lot easier, but remember, all those computerized packages out there to do the accounting will just have a little toggle switch. How would you like me to do it? Oh, double declining, go for it. And you just tell it to do it, and it does it for you.
Nice. Thank you. That helped a lot. Thank you very much.
You're welcome. Have a good night, guys.
You too.
There real quick before you go.
Sure.
Oh, I was going to tell you, Corey, it's Andrew Alkire. There's two Andrews, so it's Andrew Alkire that's on with us right now.
Okay. All right, Andrew.
Just letting you know the difference.
All right. Yeah. Thank you. I appreciate it.
Not a problem.
Is it Charlena? I didn't see you join us. Welcome. Before we go, did you have any questions?
Her mute button's on.
Charlena, your mute button is on. Let me see if I can unmute you. There you go. I think I've got you unmuted.
Okay. I'm trying to figure out where you guys are at right now. Trying to catch up.
Oh, well, we just kind of talked through chapter 3, 4, and 5. 3 in more detail, 4 and 5 kind of just an overview. And then talked about homework and any other questions about the course that they had.
Oh, okay. Well, I don't think I have anything.
Okay.
And are you going to be recording?
It is recording, and what I'm going to do is download this. It takes a while for it to download, and then I upload it to YouTube and send out the link. So by morning, you should have an email from me that shows the link and the Excel spreadsheet I used when we were talking.
Okay.
Okay?
Thank you.
You're welcome.
Thank you, Water.
Let me know if you have any questions. Good night, everybody.